Hello and welcome to the Of Interest podcast. I'm Gareth Vaughan from interest.co.nz. Over the past couple of years, central banks around the world have been battling the highest inflation many countries have experienced in decades. Overnight, there's been some very encouraging news from the world's biggest economy, the United States. The country's June quarter consumer price index rose 3% year on year, which is down from 9% a year ago. And at 3%, it's now not far above the Federal Reserve's 2% inflation target. To discuss this and much more, including inflation battles closer to home, I'm joined by Richard Yetsenga, the ANZ Banking Group's Chief Economist. Hi, Richard, and welcome to the Of Interest podcast.
Hi, Gareth. Thanks for having me.
Look, firstly, let's look at the US because that is very encouraging news from the world's biggest economy. So I'm interested to know, how have they got inflation down, I guess, relatively quickly, really, from a really high level? And what does this now mean for global financial markets and the US economy?
Well, we should differentiate the inflation they've got down. Yes, headline inflation is lower. That was always going to fall as base effects from the commodity price spike that we saw after the Russia-Ukraine war fed through. It's more to it than that, but certainly that has helped. So headline inflation in the US is at 3.0, core inflation is at 4.8. So still moving in the right direction, but core inflation still too high and just a slightly less encouraging story. How have they got it down? Primarily through monetary policy. What I think at least the numbers overnight make clear is there's a clear peak in US inflation. It's moving back towards target. Yes, we can debate whether more needs to be done to get that core number to target, but the US is well on the journey and it should short circuit any further debate about whether monetary policy works. It's one of the perennial bugbears, I think, for me, Gareth. Every time central banks are forced to do something with monetary policy, there's always a chorus which says it won't work and here are the reasons. And 6 months or 12 months or 18 months later, we turn around and we find actually higher interest rates are a blunt tool. They may not impact the economy the way we would ideally like. Certainly there are other policy tools available, but in the absence of somebody else stepping up and delivering those other policy tools, it's up to our central banks that have their inflation mandates. And so far, you'd say, I think they're doing a good job at trying to balance getting inflation back to target without crimping the economy too much.
Okay, so you talked about core inflation. So we're talking there about inflation when energy costs and food prices are removed?
Correct.
Okay.
Yep. In the US, it's excluding food and energy. You can do core inflation on a more statistical basis where you take out the things that have moved a lot to give you a more even measure. And in fact, the signal in the US is similar to other economies. Headline inflation down, core inflation down, not quite as much. But then headline inflation rose more by the same token.
Okay. Now, so for the US economy, what does this mean?
Well, it's good news. It means the Fed is close to an extended pause. We have one more 25-point rate hike in our forecasts for the Fed. I still feel comfortable with that. I think that will be enough for the Fed to then take a little period to sit back and assess what has happened. It's not obvious that pause will be followed by further hikes, but neither is it obvious that pause will be followed by further cuts. And I think that's a good signal. If it was clear that the bank had, the Fed had definitely finished and the next move is an easing somewhere out there, I think that would be a clear signal that they've actually tightened too much. Equally, if we thought there was a pause and there was a clear signal actually that the next move probably is still a hike, it says the Fed hasn't done enough. The fact it looks a bit uncertain and unclear, I take as quite a good signal. And certainly central banks, I think, will want that. They did muck it up a bit after the pandemic. They did let inflation get too high. It did become a bit too entrenched. They don't want to compensate for that challenge by over-egging it this time.
You said before that monetary policy is doing this and monetary policy is working. What is the key evidence, do you think, that is the key factor here? Because, we do have a world that obviously is normalising after the upheaval of the COVID-19 pandemic and also, I guess, moving on to a degree from the shock of Russia's invasion of Ukraine and the impact that had, especially on energy and food prices.
Look, certainly there are some supply side factors that have contributed to this global inflation spike. But also, I think there are plenty of measures which suggest that demand has been very strong as well. Look at the photos in the last month of the tourist hotspots in Italy. Have you ever seen anything like that? I mean, that's not a supply problem. It's too many consumers chasing the same goods. I'm sure New Zealand is the same as Australia. In the last 18 months, try getting into a popular restaurant on a Tuesday night or a Wednesday night. Try getting into the most popular restaurants on a Friday night. You might have to book 2 or 3 months ahead in order to do that. Look at what happened to house prices. That's not symptomatic of supply side problems. It's symptomatic of balance sheets actually being in pretty good shape and the world's biggest easing program in the history of history delivered through the pandemic and kept in place for too long.
I think the New Zealand restaurants might be a bit quieter than the ones in Australia.
Maybe now the Reserve Bank in New Zealand has been a bit more aggressive, but Australia is definitely slowing down. I promise you that. Okay.
Well, look, we'll look at New Zealand now because I think it's obviously we're in New Zealand, so it's the one that we're really interested in. And obviously, look, for the best part of 2 years now that the RBNZ, the Reserve Bank of New Zealand, has been engaged in this fight against the highest inflation we've had in 3 decades. And just yesterday, Wednesday, they had their most recent official cash rate review. They left it unchanged at 5.5%. And this is obviously after 12 consecutive increases from a record low of just 0.25%. So look, firstly, any surprises for you in the RBNZ's decision or in anything it said yesterday?
Look, it was pretty well flagged. So not a surprise to us, not a surprise to the market. And when you're trying to analyse central banks, of course you care about what they say and the way they're thinking. Ultimately, though, what they're going to respond to is what the incoming information says, and it does. The new information from the bank is they seem to be more willing to be more forward-looking, seem to be more willing to take a pause, give the hikes that have been delivered some time to be assessed in terms of their economic impact. And so on that balance, we're probably downgrading a bit some of the current data pulse and upgrading a bit. Well, let's try and see how we go. We have one more hike in our forecast for New Zealand. We have a similar forecast profile for Australia. The signal from both of those is the same. We're very close-ish, if not quite there, to what is likely to be an extended pause from the RBNZ as this tightening feeds through. I think it's worth making another point as well. You mentioned food prices earlier, Gareth. Where we are today and where we were 18 months ago are not the same hemisphere. When prices first spiked, there was a lot of narrative that, high prices will deal with high prices because they will crimp demand. Well, that doesn't work when interest rates are at 10 basis points or at 0. It does work when interest rates are 4 or 5 or 5.5 because you've got consumers that are facing high prices as well as much higher interest rates. And so I do think you will start to see spikes in prices, like we might see food prices or energy prices. Spikes in prices are much less likely to feed through into the underlying cost structure, much less likely to end up in core inflation. They're much more likely to be, dare I say it, transitory. The transitory word was not appropriate, in my view, 18 months ago. I think it's more appropriate when monetary policy is tight, which is where it is today.
So New Zealand inflation, so we are, I believe now, the only OECD country that only gets quarterly inflation data. So we get our June figure next week.
That's a claim to fame.
Yeah. I don't know that it's a good one, but it is one. Anyway, so obviously in the March year, we had consumer price index inflation of 6.7% in the year to March. We get the June data next week, and today we've heard New Zealand food prices rose 12.5% year on year in June, which is a 35-year high. And by the end of the March quarter, we'd already had 450 basis points of OCR hikes. And yet in that March inflation CPI data, the non-tradable inflation was 6.8%. which is the highest since the series began in June 1999. So, this, of course, non-tradable inflation measures goods and services that don't face foreign competition. So this is largely domestic inflation. So I guess, looking at the data we have available today, is there much evidence that the Reserve Bank of New Zealand's rate hikes have subdued domestic inflation to this point?
I mean, I think you've answered your own question, haven't you? Not a lot of evidence in the data that we have, Gareth, that it's had a big impact. Let me use an analogy here. And look, I don't know if anybody's been watching the Netflix series on the Tour de France, but I highly recommend it. If you like the Formula One version, you'll love the cycling version. If you've dropped behind the main pack, if you've dropped behind the peloton, you don't really care who's first, second, or third. All you know is you're a long way behind the front group. And in much of the last 18 months, that's where central banks have been. The detail of the economy is much less important than, wow, we just keep getting these inflation numbers which are telling us something. But when you catch up to the main pack, of course, the detail, you start to focus on very different things. It's less about the pack and more about what actually is going on in the nuance. When you've hiked by 400 or 450 basis points, the current inflation rate, yes, it's still important, but it's less additive to your information set. What is more additive is, can we see the signs that demand and price pass-through is being crimped by the policy moves that we have done? And the answer is unambiguously yes. The business surveys in New Zealand have been weak for quite a long time. We saw a very sharp fall in capacity use in the last reading. Yes, almost certainly overcooked, but even if it only fell by, let's call it half in reality, it's still signalling actually that, and this is an economist term, I don't want it to come across the wrong way, but it's signalling that the demand destruction that you want to see to rebalance supply and demand in the economy is occurring. And ideally, we would be doing more on the supply side in New Zealand and Australia and elsewhere. Central banks don't control the supply side of the economy. All they can do is impact demand to get inflation back to target. And I think if you're analysing monetary policy today, I think quite a lot less weight on current inflation, quite a lot more weight on what can we see to tell us where things are going.
Yeah, and you mentioned the business confidence surveys, etc. Now, I mean, obviously, things are getting tougher here for anyone who has a loan, obviously, because their interest rates have gone up, albeit in New Zealand, in the mortgage market, we're mostly on fixed term rates. So on that side of it, obviously, it takes time to flow through. So I guess the concern here might be that we have had obviously 2 consecutive quarters now of falling economic activity, only just, but we have the business confidence surveys are very negative. We have a lot of, monetary policy still to feed through to the home loan market. How bad might things get in New Zealand before they get any better?
Well, I mean, New Zealand is already in technical recession. You might say it's already quite bad. I mean, I'm probably being not quite accurate. Yes, the GDP data is in technical recession, but the unemployment rate is, I think, not much more than half a percentage point off its low. And that's obviously, in an ideal world, we'd have unemployment as low as possible, but it does seem like it was too low to be consistent with the inflation target. So some increase in that is welcome. There's no reason that it has to get much, much worse. Certainly, we would expect to get core inflation back to target and to keep it there, that we will need to see weaker demand in the New Zealand economy. The unfortunate and uncomfortable reality is that will be associated with a different labour market outcome from what we've been dealing with. Lower wage growth, probably some higher unemployment at a top-line economic perspective. But also, the more forward-looking the central bank can be, hopefully they can get the balance on this roughly right, where you slow those things enough to get inflation back to target, but not so much that you have to turn around and ease aggressively soon. And certainly, to the extent this tightening cycle has been extremely correlated from a global perspective, when I look across the landscape, I have quite a high degree of confidence, actually, that central banks have done a good job in balancing this so far, and we are likely to get a landing which is, look, I don't want to say soft landing because it's not going to be feather soft, but certainly a landing that's not too bumpy.
Okay. Interested in having a bit of a look at Australia now. So obviously in a context of a bit of a comparison with New Zealand, because of course in New Zealand we love to compare ourselves to Australia, as you're well aware. Obviously the RBA, the Reserve Bank of Australia, has been less aggressive than the Reserve Bank of New Zealand with its interest rate hikes. Well, the RBNZ has gone to 5.5% from 0.25% since September 21. The RBA has increased to 4.10% from 0.10% in May 2022. So obviously the RBA started later, hasn't gone as high, yet the inflation, consumer price index inflation and unemployment readings are pretty similar in the two countries based on the most recently available data. So I mentioned that New Zealand CPI 6.7, the last quarterly Australia one was 7, and unemployment here, the last one was 3.4%, Australia 3.6. So I guess, I'm interested here in why have the two banks taken quite different approaches and yet seem to be getting similar outcomes? What's behind that, do you think?
Well, if it makes you feel any better, the wisdom of crowds would seem to be on the RBNZ side, because the US Fed, the Bank of England, they're also in the fives, and we're forecasting them to get to 5.5, and the RBNZ to get to 5.75, and the RBNZ to get to, let's call it 4.5.
The RBA,
in round
sorry,
numbers.
4.5.
Sorry, the RBA to get to 4.5. I think the reality is the bank is trying very hard to achieve kind of this narrow path outcome, is the phraseology they've used. And so they're very concerned about over-tightening in Australia. I think you also need to remember the great Australian household leverage story hasn't disappeared. Certainly the household sector has gone through a lot of balance sheet repair the last 15 years. It's in a much stronger position from a net asset perspective. The households that have the debt that is in the economy do seem to be the stronger households. So there are some reasons for thinking the household sector today is better than it was yesterday, but it still does stand out from a global perspective. And of course, more Australian households tend to be on variable mortgage rates, and when they fix, they tend to be on shorter terms than you see in other economies. The US is the extreme, of course. A lot of households have 25 or 30-year fixed rate mortgages. New Zealand, obviously, somewhat shorter than that. There is a risk that the Reserve Bank of Australia hasn't done enough. But I'm quite comfortable with the idea they're getting very close to an extended pause, and let's give the tightening that has been delivered by the Reserve Bank in Australia some time. Let's see how it's actually impacted demand, and if we need to, we can hike some more later, and hopefully we don't have to.
I'm interested in having a chat with you about China as well. I saw earlier in the week you were tweeting about the Chinese inflation data, so describing it as remarkable. Headline consumer price index inflation there, 0.0% year on year. So, I mean, this is remarkable compared to much of the rest of us. What is going on in China? And, I mean, are we talking about deflation there?
We are talking about deflation there. Raymond Yung, our China economist, has used the word deflation in the last 12 months in his research more than probably in the last 20 years in China. And that in and of itself, I think, captures the reality of the Chinese economy today compared to what most of us understand and have become accustomed to about China. And it's worth remembering China joined the World Trade Organization in 2001, about 20 years ago. We need to separate, I think, our expectations for China in the next 20 years and what China has looked like in the last 20 years. I don't think those two things will be in any way comparable. Certainly, China is a $17 or $18 trillion economy. It's second largest in the world. The third largest economy is Japan at about $5 trillion. You can't replace China. It's not getting replaced tomorrow, but it has a very different rate of economic dynamism. It's likely to grow much more slowly. It has some much larger structural challenges than it's had. And if you want to simplify those down, there is a bunch of them. Like most economies have structural challenges. China has a demographic challenge which has come upon us with quite quickly. And I think demographics it's a bit like the springs on the trampoline. When you're young and vibrant, you jump as long as you like, never seems to hurt. If I don't know the last time you jumped on a trampoline, Gareth, I'm pretty sure you got off and thought, wow, my back really can't do that much more of that. I think China is in the sore back stage, and it just means that the economy will struggle to generate growth more quickly. It will struggle to recover from shocks as well. Policy stimulus can absolutely have an impact, but the boosts it tends to give to the economy, I think, will be less vigorous than we might have been used to historically, will tend to not last as long. It's not the same as Japan, but there are some elements of that flavour, I think, in what's coming through in the Chinese economic story now.
Obviously, you'll be well aware that in the North Island of New Zealand, we've been hit by a lot of severe weather this year, flooding and cyclones doing billions of dollars worth of damage. And the rebuild of that will stimulate the economy, which the Reserve Bank, again, in its Monetary Policy Committee statement yesterday, referred to this, and that this will support economic activity. And then I guess on the other side of that, we're seeing insurance premiums increasing, with the biggest insurer, IAG, talking about 20% on car insurance and 20 to 30% on house insurance. Also, I guess, weather-related news in other parts of the world. I was interested to see the European Central Bank estimating that the hot weather they had in the 2022 summer over there had increased food inflation in Europe by about 0.67 percentage points. So I'm just wondering, this growing volume of extreme weather events that we are witnessing around the world, what's this doing to the long-term outlook for inflation?
That's a great, vexing and troubling question, I think. It's never far from the surface of my mind, because it seems like, and sorry to delve into the pessimistic zone for a while, but it does seem like we're very much seeing the effects of climate change at the same time as we're trying to really get into the teeth of climate change mitigation. The sense that we had a choice about this, that we could mitigate or adapt, that choice seems to be disappearing. It seems like we're going to have to mitigate and adapt at the same time. And there's no real projections for what that world looks like. I was reading this morning the surface ocean temperature off Florida in the US hit 30 degrees during the heat wave in the last week. I'm an ocean lover. I can't conceive of what a 30-degree ocean surface temperature actually looks or feels like, or in fact what it does to ocean life. I think the main economic impact, at least from a macro perspective, is this is a supply-side shock which will tend to boost inflation and will tend to worsen incomes. And so it hits productivity as well, and it reduces standards of living. The reduced standards of living in economic terms is not a particular surprise. As we brought the climate externality kind of into the economic net, I think we should have expected that it was going to cause us some challenges. But to have both the adaptation and the mitigation challenges at the same time is really climate challenge squared, unfortunately.
Indeed. Just looking at, I guess, the big picture, obviously before COVID-19, we had central banks being criticised for inflation being below their targets. Obviously, since the pandemic, it's flipped the other way, and it's now, oh, look how high it is, it's way above your targets. And looking at those changes going on around the world and the challenges we face in the years ahead, you did mention earlier about the classic line about interest rates being a blunt tool, the official cash rate in New Zealand, cash rate in Australia. It's a blunt tool. Do you think that central banks are going to need new tools? And if so, do you have any ideas what they could be?
Not necessarily. Look, conceptually, of course, we could try new tools. During the pandemic, we tried new arms of policy. We tried loan forbearance. We tried suspending bankruptcy provisions. And many economies, of course, did the same thing. We pursued large-scale income support. And what all these policies did actually was take the bottom out of the economic collapse. What makes a recession deep and damaging and the recovery slow is the loss of firms, the loss of jobs, Structural change often accompanies economic downturns. If you think about the vacancy rates in CBD property, for instance, which you read about around the world, you end up with assets and businesses and people's skills tied to sectors which are not as economically viable as they used to be. And the more of that you get through a downturn, the longer the upturn takes. And if you think about the global recovery out of the global financial crisis, enormous structural damage, lots of bankruptcies, unemployment to double digits in a number of large economies, it took many, many years for policy to really gain traction and get the recovery going. The policies we pursued through the pandemic effectively cut off a lot of that structural damage, allowed us to bounce out of it. We clearly underestimated what the bounce would be like, and maybe it's created other problems for us in the post-pandemic economy, but as a way to protect livelihoods, I think we learned a lot. So we're always kind of messing with the policy toolkit, but the complication becomes central banks have a relatively simple mandate. It has become fuzzier, but a relatively straightforward mandate around inflation with some other things increasingly bolted on, and a relatively simple toolkit with interest rates as the kind of the head chef. The more cooks you want to add into that kitchen to assist the head chef, the more complicated you make it, the greater the chance for unintended consequences. And this is not to say interest rates are the best tool, but certainly I think there are gains in having simplicity in the policy process. A single target, a single lever in what is in reality in most economies an unelected institution. If you want to get complicated and funky, the government of the day is probably in a better place to do that, where actually the citizenry can have some control over how those policies are assessed and whether in fact they make sense.
Well, look, Richard, thanks a lot for that. That is Richard Yetsenga, the ANZ Banking Group's Chief Economist, and I'm Gareth Vaughan from interest.co.nz with another episode of our Of Interest podcast.